Thank you for joining us today. I am Charlie Wilson, and I'm the owner of Charles Wilson, Inc., a CPA firm. Today we're going to talk about the new tax bill and the effects on individuals. This is the largest tax bill in over 30 years, and there are a lot of complexities related to this tax bill as it relates to individuals. Minimizing taxes is all about planning ahead and knowing the rules, and that is what we're here to do to help you. The Tax Cut and Jobs Act provides for many changes to individual tax provisions. With a few minor exceptions, the provisions are generally effective starting in 2018, and the majority of the changes are temporary and sunset after 2025. Due to the number of changes and also some new concepts introduced in the law, there is a need for guidance from the IRS and possibly from Congress in the form of technical corrections on the application of the law. There are also many questions about which states will conform to any or all the federal changes. Some of the basics. The number of tax brackets did not change. For all income ranges, the new tax rate is the same or lower with the new tax bill. The standard deduction nearly doubled in amount. For 2018, the amounts are $12,000 for single, $18,000 for head of household, and $24,000 for married couples. Personal exemptions are suspended. The child tax credit was increased to $2,000, refundable up to $1,400, and there's also a new $500 credit for dependents that do not meet the child credit requirements. Individual AMT is retained. However, the exemption amounts and thresholds were increased. Income levels are indexed for inflation using a new chained CPI instead of just plain CPI. Capital gain rates also stay the same, with the highest income taxpayers paying 20% on capital gains, while also facing the net investment income tax of the 3.8% on top of that. The breakpoints of capital gains and qualified dividends no longer follow tax brackets for regular income tax purposes. On the slide is shown the breakdown. There are numerous changes to itemized deductions. First, the overall limit on high-income taxpayers' itemized deductions has been repealed. And then for medical deduction, the threshold will be 7.5% in 2018, but returns to 10% in 2019. The home mortgage interest deduction was modified to reduce the limit on acquisition indebtedness to $750,000 from the previous $1 million limit. A taxpayer who entered into a binding contract before December 15, 2017, and closes on the property before April 1st, 2018, is considered to have incurred the debt prior to December 15th and is therefore subject to the $1 million limit. Home equity debt is not grandfathered, however, and the interest is no longer deductible. State and local tax is now limited to $10,000, $5,000 if you're married filing separate or single. Also, miscellaneous deductions subject to the 2% AGI threshold are no longer deductible. There were no changes to the investment interest expense. With regard to the miscellaneous itemized deductions subject to the 2% AGI, here are some examples which will no longer be deductible. Unreimbursed employee expenses, tax prep fees, hobby expenses, legal fees, and safety deposit box fees. There are some expired provisions Legislation at the end of 2015 extended some of these items only through 2017, and then there was legislation that some of these were also then extended again through 2017. These are the provisions that are not in effect at this time. For 2017, legislation is still possible to address these retroactively, but the discharge of qualified personal residence indebtedness, the ability to deduct mortgage interest, insurance premiums, tuition and fees deduction, and the energy credit. In the new tax bill, there is at Section 199, the 20% pass-through deduction. This new provision provides for a 20% deduction on qualified business income. This deduction is taken on the individual's tax return from taxable income and can result from the flow through of income from a sole proprietor, single member LLC, a partnership, or an S corp. The calculation is very complex and can be limited based on taxable income as well as the type of trade or business income that is applicable. The limitation based on W-2 wages and capital is phased in when taxpayers' taxable income exceeds the $157,500 or $315,000 married filing jointly threshold. A disallowance of the deduction with respect to specified service trade or businesses is also phased in when taxable income exceeds the threshold amount. There's a great deal of questions on how this deduction will be applied, and more guidance is needed. The Affordable Care Act impact. The individual mandate to maintain insurance coverage was repealed as part of the new tax bill, but that doesn't start until 2019. So for 2017, 2018, the information will still need to be gathered from individuals on their insurance coverage. The IRS has stated that for the upcoming tax season of 2018, they will not accept electronically filed tax returns where the taxpayer does not address the health coverage requirements of ACA. The effects of the net investment income tax. The net investment income tax went into effect in January 1 of 2013. The income thresholds for this tax, $200,000 for single or head of household, or $250,000 for married couples, do not adjust with inflation, and no changes were made to these with the new law. If you have any income above these thresholds and have certain net investment income, you will be subject to this 3.8% tax on the lesser of the net investment income or the excess of income over these thresholds. Investment income subject to the tax include taxable income, taxable interest, dividends from stocks and bonds, certificates of CDs, mutual funds, and capital gains from the sale of these assets. If rental income is treated as passive, then it is subject to this tax. Activities that meet the self-rental or real estate professional rules are not subject to this tax. Due to the changes for state tax and miscellaneous itemized deductions, the expenses to reduce the net investment income are no longer limited or no longer available. So taxpayers should be aware if they are subject to this tax, the amount will likely increase. Alternative minimum tax changes. The AMT exists to be sure everyone pays the minimum level of tax despite using various exclusions, deductions, and credits to reduce their regular income. And AMT exemptions are $109,400 for married filing jointly, $54,700 married filing separately, and $70,300 for single or head of household. And a phase down of the exemption is much higher. Due to the increase in the exemption, increase in the phase-out amount of the exemption, and the limiting of several of the key triggers of the tax, such as state income tax and miscellaneous deduction, it is likely that less taxpayers will be subject to the AMT. However, since it is still in effect, careful planning should be considered whether a taxpayer is subject to this tax. Changes to retirement planning. Effective for 2018, the reconversion rules cannot be used to unwind a Roth conversion. If an employee stops making payments on a retirement plan loan, a deemed distribution generally occurs. This deemed distribution isn't eligible for rollover, but in circumstances, the obligation to repay the loan is accelerated, if not repaid, and the loan is canceled, and this creates a loan offset. This is treated like a distribution from the plan, and the amount is eligible for a tax-free rollover to another eligible plan within the 60-day limit per the old rules. For these plan loan offsets after 12/31/17, the rollover period is extended to the due date of the employee's income tax return. Estate and gift tax changes. The increased exemption further simplifies the estate taxes for federal purposes, but that doesn't mean you don't need to do estate planning if your wealth falls below the exemption level. Many states have much lower thresholds, and proper planning can alleviate some of that burden. If you had any significant changes in your family, such as a birth, marriage, divorce, or death, it's still important to revisit estate planning documents to make sure that all the necessary changes are protected. Education tax benefit changes. Under the pre-law, distributions from a 529 plan could only be used for qualified higher education expenses. For distributions after 12/31/17, qualified higher education expenses include tuition at elementary and secondary public, private, and religious schools. Unused funds in a 529 plan can be transferred to the ABLE, ABLE account of a family member. Or discharges of indebtedness after 12/31/17, certain student loans that are discharged on account of death or total and permanent disability of the student are excluded from gross income. Then some other individual changes of note. A personal casualty loss is deductible only if the loss is attributable to a federally declared disaster area. Alimony is no longer deductible by payor nor includable by the recipient for divorces executed after 12/31/18. Moving expense deduction and exclusion is repealed except for members of armed forces. Kiddie tax is now tied to the trust and estate rates rather than the parents' rates. This provision expires after 2025. Charitable contribution changes. Cash contribution AGI limit has increased from 50% to 60%. This increase is temporary and expires at the end of 2025. No charitable deduction is allowed for a payment to a higher education institution in exchange for which the payer receives the right to purchase tickets or seating at an athletic event. This provision is permanent. Another change is that the exception to the contemporaneous written acknowledgement requirement was repealed, meaning that the written acknowledgement must be obtained now for any contribution of $250 or more. State and local tax issues. The new tax limits that aggregate the state and local property tax not paid, accrued, and carrying on a trade or business, and the state and local income tax is limited to $10,000. Special rules prevent the deduction of prepaid taxes. IRS guidance on real estate taxes can be, for rental properties, can be obtained off the IRS website. Planning now to avoid underpayment penalties. Withholding will be changed based on the new tax tables for 2018. It is important to take a look at the 2018 tax situation that you may have to make sure that you have the appropriate number of exemptions for withholding purposes. Proposed changes not included in the final bill, but were either part of the House or the Senate bill, include additional standard deduction for elderly and blind, the $250 above the line teacher deduction, exclusion for employer provided dependent care assistance, exclusion for adoption assistance program, reduction in capital gain rate changes to taxation of interest income, exclusion of sale of principal residence, required use of first in, first out to determine the basis of stock distributions. Charitable driving remains 14 cents per mile rather than actual. Consolidation and modification of education provisions, and plug-in electric vehicle credit. Some of the planning tips, due to the many changes across the board that this new tax bill contains, many planning strategies will need to be evaluated and examined to make sure they still make sense. With the reduction of the corporate tax rate to 21%, this may cause a need for evaluation of choice of entity for current and future business plans. Also, due to the overall changes in itemized deductions, charitable giving timing will likely be more important. And as stated earlier, due to temporary nature of the estate changes, estate plans will need to be reevaluated. With AMT changes, different decisions may need to be made related to exercising incentive stock options. Also, for individuals with pass-through income, incentives for classifying activities may be different than in the past. So many things we do have tax consequences that we often don't think about until it's too late. Changing jobs, having children, planning for retirement, exercising stock options, receiving a promotion with a nice raise, opting into employer-provided retirement plan like a 401k plan, transitioning parents into long-term care, and many more. Today we touched on the major topics at a very high level, but with the new complex tax laws and changes to your particular situation, it is always a good idea to review how the tax laws affect you specifically. That is where we can come in and help. That is what we do. Thank you for joining us today on the discussion of the new tax bill and how it affects individuals. The new tax bill is a complex piece of legislation, and it affects individuals in a number of ways. Minimizing taxes requires knowledge of the rules, and it requires planning. That is what we're here to do. So if you have further questions, please email us or contact us by phone. Thank you.